All right, we're going to do YouTube Pro Sentiment, and starting with Eurodollar University. Let's see if we can find it. So, the video discussed the unemployment rate and its relationship to inflation in the U.S. Despite a historically low unemployment rate, inflation has not increased in tandem. The Federal Reserve acknowledges that the unemployment rate is not a dependable indicator of inflation, and they are unsure of what drives inflation. The video argues that there is no correlation between a tight labor market and inflation. The video also introduces Eurodollar University. Yeah, blah blah blah. So, like there's weird ideas around inflation. Like, I agree with Alf. He's like known as Macro Alf, and he basically says any kind of money printing that the Fed does is not printing money. They print bank reserves. So it's hard to see that translate as inflation. The money that gets printed is on the bank's side, the private side, and usually, I would say 2/3 of the time, the bank reserves that get printed by the Fed get used as insurance. They don't get used as any kind of risk on kind of way. And everything else is the market participants and the supply chain. So that's kind of my belief, is that the inflation is coming from market participants or behavior of the market or the supply chain. And they kind of, it's hard to determine the cause because of just the muddling. But the way I understand inflation and its relation to the Fed is not through printing QE. That's not my understanding. But this one is, arguing that the low unemployment rate is not in relation, is not with inflation. And I agree. And I think he also agrees that it's related to supply chain, because I've heard him say it before. So that was Eurodollar University. Let's go to Trading Fraternity. See what he has to say recently. Why the stock market isn't crashing yet. In this video, the speaker discusses the current state of the stock market and why it's not crashing yet. The speaker mentions the concept of a no-landing scenario, how strong economic data such as retail sales and rebounding real estate and industrial production have contributed to this scenario. The speaker also talks about how inflation has been decreasing over the past few months and how this has been a factor in the market's resilience. Additionally, the speaker discusses the S&P 500 buyback index, which shows that companies that have done buybacks size are performing well. So that's interesting, because I've seen almost the exact opposite. So a channel that's not on here is Charlie Bilio. I think that's how you spell his name. But let's go ahead and see what he has to say, because it's almost the exact opposite of what he's saying. So excluding this narrative, this no landing scenario, the buyback size and are performing well. I think those kind of the buyback program is slowing down a lot. So he made one day ago. So we're going to load it up and see what he has to say. The main topic of the video is basically weekly charts. What are some of the key charts and themes discussed in the video? Maybe it didn't get the whole transcript. Okay, so I've watched a little bit, and I get his weekly uh, thing. So the biggest thing to notice is that the revenues are pointing down from the FANG stocks: Apple, Microsoft, Alphabet, Amazon. So that's what's noteworthy, is like they're slowing down. They're actually feeling the pain, and it's hard for me to believe that the buyback will be continuing. And then there's some stats or some Snapple facts. Tesla's slowest growth rate since 2020. Amazon's third slowest growth rate. So we got a really slow growth rate, and revenue is decreasing. So it's the charts that were saying higher. I don't know, like trading fraternity, this unique situation. The unique situation, I believe, like I watch Forex, so I see what's going on in Forex. I believe it's related to what's going on in Forex. And Forex is related to the bonds. And the euro has pumped, and the dollar's pumped, but it's coming down, and there's like a big inefficiency. So one's going to take profit on that inefficiency, and it's going to fill it, and that involves the dollar coming down. Because the dollar's moved a lot within this last week or last 5 days. And specifically, if I were to show you, when we broke out here, we put in a huge engulfing, and that's kind of where this purple box is. We had an untested breaker on the 12-hour, but now it got filled. But the 4-hour still has this untested breaker. It's going to want to retest. It's a big magnet. And there's a lot of there's an imbalance here, so it's going to want to come back. So we'll see. This is showing like risk off sentiment the higher this goes, but at the same time, I don't believe it's over. If we were to, I don't know, I just don't. I believe it's going to come back. If we were to use some kind of cheating way to figure out if it's on its way back, is through this 4-hour oscillating divergence sell signal. If we got like a 4-hour close above here, then maybe, like, I'm wrong. But as far as I know, I think the dollar's rolling over, so it can retest this breaker and fill the fair value gap here on the 12-hour, or in the 4-hour right here. Fair value gap is green. Not always do these magnets or fair value gaps or the untested breaker are they successful. But looking at interesting ways of reading price action, this is my suspicion. This is my best guess as to what's going to happen, is that the dollar, this is a swing failure pattern, deviation, left shoulder, right shoulder, and it's going to want to come down, and it's going to retest and come back up. It's going to want to range trade. I do believe we're heading higher, and this is beginning the risk off sentiment, but it's going to retest. So when we look at a higher time frame like this 3-day, we don't have any kind of real retest candle. And if we close the week on these 3 days, I think there's just another retest coming. That's just my suspicion. And it would fill all the way down here. I don't know, or maybe it's down here. I just see that we got a red dot on the 4-hour, and I listen to these red dots. They're lagging too, and as long as these swing pivots are respected, then that's all I need. As long as this is respected, it doesn't go any higher, and that this counts as resistance here, specifically like right there, then there's nothing to worry about. This is the worst we can expect, and it would roll over on the dollar index. But that's kind of my suspicion, and that's kind of what I'm getting at. And what would fill the weekly fair value gap is that the dollar going down. So this is the weekly fair value gap, and I want it to fill, and it kind of really dominates my bias here. But it is with reason, because if we look at the euro, we broke out on the euro on the 4 hour, and it's making a symmetrical triangle. So there is a chance that we could go up in something like this on the euro. Something like that. I don't know. We might touch the last week high and be a lower high, or we could totally stop it out. But I think 51% of the chance is that it makes a lower high at the last week high. But it's coiling up to make a move, and it looks like, based upon the market structure break, the retest, and the holding, it's gonna give us a nice kind of sprint. So that's just like a short-term move. And this is on the dollar. I just think it's going to come back to this breaker if the euro does that. Now we are front-running it. We haven't broken any 4-hour market structure to the downside, but I think it's coming. I think it's coming. And I have no idea what in the bonds would do that. I think it has to do with maybe the bills. But I have no way to prove that. The best way, Game of Trades, they made some kind of fundamental suspicion. Game of Trades.
11.
Oh. And I think it was this one. So they made one 15 hours ago. So we'll take a look at it. So yeah, there's some new buzz around the Fed funds rate and how it's changed since the release of news on Wednesday. So there's been like a new update on the Fed funds. So I think this is the one. So, yeah, the tag of the VIX on the downside. Okay, so I think this is going to all talk about the VIX. VIX, yeah, with it being consolidating in the low area, like this is why I think it's going to consolidate, is because it's this breaker to the downside. And with that breaker to the downside, it makes sense that like a bullish move can get away. I don't think it's going to go lower. Maybe we might have equal lows here. But I think for the most part, it's just going to consolidate here. And this consolidation is going to enable enough time for a spike, a bullish spike, to fill that fair value gap, the weekly fair value gap. So this is not the video that I thought it was. Let me... oh shoot, I want the channel. It must have been this one. But we'll read it too. Here it is. The spread between the yield for holding BBB rated corporate bonds and cash is at its lowest since 1979, indicating investors' high-risk behavior, which is a sign of greed. However, the accuracy of the chart predicting moves is debatable. So this, to me, is the one that it's talking about. I think it can show us a chart. Here we go. U.S. BBB rated corporate bond yields and a 90-day U.S. Treasury bill. So with it being so cheap, I don't know if that's an index of the two, but it's indicating risk-on behavior, and that fits really well with like a crazy squeeze. So that's kind of just the fundamental side of where I'm getting that fill of the weekly fair value gap. The weekly fair value gap just gives us a target, and in some way it also paints a narrative of what to expect, because for the most part, I would say it's within good probability that it fits the technical narrative. Um, but because the overall fundamentals is bearish, but for something that would be a good short-term move that would support that would be this triple B rated corporate bonds and cash being so cheap. So that's kind of what has me really interested in this fill the weekly fair value gap and then a quick turnaround, and it matches with the dollar coming down back to cheap levels and playing the range. I mean, it looks like it could be a double bottom bull flag, or it could totally be some kind of deviation. And I would like to think that this is going to be a deviation, but who knows? And then we got the euro powering up, risk on kind of currency, and then the yen. So another thing that really supported me to go after this bullish fill is the breakdown in the yen on the 12-hour. We could as easily flip back up, but I think with that 12-hour market structure break and the lack of breaking the 4-hour here, it's a good sign for me to let's remove that. And we broke the daily breaker, so that's kind of interesting. And just the lack of breaking the 4-hour is telling me risk on. It's telling me what the triple B beta rated bonds are seeing in the cash is it's cheap. So I'm going after it. I mean, we broke down the 4-hour VIX breaker. So it's saying just near term wise, going after this fill sounds like a good idea. Now, is it going to be without volatility? No. And that's kind of what I'm expecting. But to finish this, these charts look mostly bearish. And that's really showing why if we do fill the fair value gap on the week, to really be prepared to flip bearish. I think '08 filled a weekly fair value gap, and it flipped as well historically. Amazon net income is at an annual loss. I think we have no, we don't have Amazon coming up for earnings. I don't think so. We can take a look. So February 16th. So Amazon. Maybe we had it already. Let me do a Control F. We had it already. So today's just applied materials and Deerco. Next week we got Nvidia and Walmart, Home Depot, Palo Alto Networks, and we might really see the earnings recession come through. I mean, if we see in the FANG stocks things rolling over in revenue and what is this chart here? Sales growth. I think what was this one? Net income. Yeah, we're gonna see it. The FANG stocks, the companies that have the largest kind of sales and just everything, cash flow. For this a significant kind of move to see these kind of indicators of fundamentals in companies is really good for stockpiling. Whatever event we're coming to or some kind of bottom, it's a really good sign for cheap things to come, and it's also a sign of just peak speculation for what's going on here in the fundamental side. Yeah, it looks like EPS growth, sales growth, like everything's on the down, like close to zero on maybe year-on-year change, or I don't know what percent change or what kind of graph this is, but operating profit margins they're starting to come down, and along with the and then he talks about this
Most
the
recent
unemployment
report
rate.
blowing out estimates, which were under journal, looking at that tech sector, so the information technology sector.
So I will say, like, I don't like his explanation, and I did listen to one of the videos, and he does say how like printing of the money in the Fed, and there's some like financial literacy there, but everything else, as far as a fundamental company investor, is good. Um, but I don't trust his macro, like non-farm and like unemployment data. I leave that to Jeffrey P. Snyder. That he's like the guy. um, so now he's talking about the strong labor market, and then he's talking about the Fed and just kind of that narrative, that they're at war with each other, and now he's talking about the earnings and the earnings coming down, and just how it's indicating just a poorer outcome of a future in some way. And with the Fed, you just don't fight the Fed, you don't fight the tape. And sometimes the tape is fighting the Fed. So you just gotta play the hand you're dealt. And sometimes that means staying out. But for those of who have a lot of heart, go for it. And then he's got saying there's a lot of hedging going on, people seeking safety. Um, Looking like based on a survey, people's financial situation is worse off, about 50% worse off, and 35% better off. It's gone down, the better off, and it's all coming from mostly the lower income, and then middle income. They're the ones highest getting squeezed. There was a narrative saying that the now was a time for the lower income to do better, and I think that's BS. Like, looking at this survey and seeing the food prices, it doesn't even look close. Like, yes, there's an overall like poorer outcome comparatively to last year. So everyone's doing bad, but the ones that are getting hurt the worst is the lower income because of the inflation, the higher food prices, higher housing prices. Those haven't come down yet, and the sticky inflation is still sticky. If you go, if you, I can't pull it up. My roommate showed me. He pulled up the Atlanta Fed and showed the chart. But yeah, like nasty stuff, like weird narratives, and you gotta really look at it yourself. Don't take my word. You and because like there in this industry, man, there's a lot of noise. Like there's a lot of narrative, and figuring out what is the right narrative is the like, difficult part. But um, it's equipping yourself to be able to handle what's coming.
Their
Interesting.
dividend later this year. So shareholder friendly changes. Stock initially jumped on the news of this, then it came back down. So we'll see what happens from there. But this is really a broader trend that we're seeing across the landscape here, where companies during 2021, it didn't matter really what was going on in terms of the bottom line. It was all about revenues and all about growth in revenues. And now, much different market. People are really paying attention to those profit margins and profitability numbers, net income numbers, and they're really punishing companies that are failing to show improved profit margins and failing to show positive net income. So very different environment than where we were in 2021 at the peak of the mania. All that mattered was driving that top line number higher, and today it's all about that bottom line, with companies trying to get there, trying to get to a better bottom line by cutting costs. So many of these companies hired too many employees. They were expecting huge growth rates to continue. That didn't happen, and we're seeing really a right sizing of many technology companies. If you look at the share prices, things like
Earnings
Facebook,
recession.
many examples, Netflix, of these companies that have cut costs, and you're seeing the share prices start to move in the opposite direction. So investors, in the long run, companies are valued based on long-term stream of earnings, not revenues. And so these cost cuts, if they can improve profitability, investors are liking that and rewarding companies that are doing that and doing that in a fashion that will help Murphy and Dan Aykroyd are down in the trading pit. And they have
Oh wow! So he's talking about the soft
inside
commodities.
information that the crop report was going to be good, and that was going to send orange juice prices down. This, we're seeing the opposite scenario here, where Florida's orange crop has just been decimated over the last year. Hurricane damage.
Oh, there it is,
Citrus
right
greening
there.
disease, and so oranges in short supply.
Wow, the
Similar
softs
that
are
we
getting
talked
hit
about
hard.
in terms of eggs. In the last video, we're just seeing that supply
That's
demand
crazy,
imbalance
man.
lead to a spike in prices. This was kind of
half a
crazy.
year.
I saw this, that the average price
Year.
of a
Oh
gallon
my
of orange
gosh.
juice is up to $8.78 a gallon.
Wow.
That's just unbelievable to me that it's that high. Now, orange juice to me is not like eggs.
Wow, that's
I think this is gonna
crazy.
obviously impact demand. It probably already is. You can substitute orange juice for other juices or just drink water, obviously. Instead, I think
good thing I
most
stopped
studies
drinking
now
orange
show
juice.
that juice is not very good for you given the sugar content. But what I suspect is what we'll see is going to be similar to what we're going to see in the egg prices, which is this is going to be rebalanced here from a combination of lower demand and supply coming back. But just another example of supply and demand in markets working their way out. And the cure for high prices, as the saying goes, is high prices. So having this price this high, if there's a substitute, people will substitute it, make that substitution, and the price eventually will come down. And again, that supply is going to be replenished at some point. So if we talk about inflation relief, most things are not going the way of orange juice, thankfully. They're going in a much better direction. And so I want to end with this positive note where we're seeing just these more and more signs of things moving in the right direction. We look at used car prices, again, was a big leading driver of, important leading driver
Coffee.
of
Oh my
inflation,
gosh.
higher car prices in general, just going up at tremendous rates of growth. And now we're seeing the opposite in a very
Oh
rapid
man,
fashion.
that's crazy.
Average price of a used Tesla is now down over
I haven't.
$22,000
I took most
from
of
its
these
peak,
off the
last
softs.
July. It's just stunning declines here, week after week. And we've talked about what's driving this, so I won't talk about it again. Higher interest rates. Tesla cut the price of new cars.
Yeah,
lower
there it
demand,
is.
Combination
It's
of
trending.
these factors leading to price declines. And this is good news for the U.S. consumer, of course. And if we're looking at global freight rates, the trend has
Oh
continued lower. Now we're
man.
at the lowest level
Oh
since August
shoot.
2020.
We're going for a
82%
second leg of
lower than
inflation.
2021 levels.
This is
Not
crazy.
quite at pre-pandemic levels.
Who would have
yet,
thought the
but
softs
we're
would
getting there.
skyrocket like
And so
this?
this is really further evidence that the supply chain issues are
Supply
easing.
chain, see?
This is going to
This is
have
supply
a positive
chain.
impact
This is
on
not
future prices. So very good
whatever
news.
people are talking
And
about.
my favorite, of course, is the fertilizer price index here,
Oh
and that just
man, this
continues
is
to
getting
go lower.
bad.
Just huge decline
Okay.
from its peak. In,
Sorry, I'm not gonna
March
amp it up anymore.
2022. Now
Like,
we're at
that-
the
that
lowest
was-
level since February
I'm just in
2021. So the one thing in that
Disbelief
inflation
that
report,
this is
hopefully
happening.
the next one
Like,
that we
I
see this week,
prepared for
we will
this,
see some evidence
but
of this. The one thing
never
that
what I
hasn't
thought
started
like
to
this would
move
be this
lower in a
crazy. We
meaningful
just
way has
broke
been the prices of food. And
market
so
structure to the upside.
fertilizer prices tend to be
On
highly
wheat.
correlated with
So
food prices.
we're getting ready
Hopefully, this decline is going
for
to start to impact the price
run.
of food, and we're going to see a much lower rate of inflation there. In
O-
the next few
OJ.
months.
Yeah, here we go. OJ.
Lastly, talk about natural gas, and thankfully, it was a much warmer winter than pretty much anyone predicted.
It's crazy.
That has caused the price of natural gas to plummet, 77% decline. If you're looking at your energy bills, you're going to notice a big difference in the next few months. Natural gas versus what you were paying. A huge difference just in a few short months is a positive
Okay,
factor for
Lean Hog's getting
everybody
ready to
in the
break out.
world. Low energy prices
So
are
like
huge in
these are
terms of
all just prepping
increasing
for a
people's
run.
prosperity. So
Cattle, oh my
having cheap
gosh.
access to cheap energy,
Oh my
one of the
gosh.
main reasons why people's standard of living has increased over time, because inflation adjusted energy prices are much lower
Oh
than they
my
were 20
gosh.
years
This
ago.
is
That's a
not
great
good.
thing for everyone. So hopefully the price of natural gas remains
Like the
low. We
Fed
don't see
is
another spike
this
higher.
is saying the
And
Fed
so
is
across the board,
it's not doing
exception
well.
exception of orange juice, we're
Like even
seeing
if we were
much
to
better things in
have the
terms of
market come
inflation.
down,
So I suspect when we get that
it would
inflation number, we're going to see
it's energy
another
for another
decline
run.
on a
That's how
year-over-year
I see it.
basis. So very good news. We'll see what the market's reaction to that, and we'll talk about that in next week's video. So let's end it right there.
Oh
Have a
gosh.
great week, everyone. Thanks for joining. If you like the
Soy
content,
meal, yeah.
subscribe to the channel, and we'll see you
Anyways,
next time.
I think we're done with that. That just was wild. I just did not see that coming sneaking up on me like that. Like I monitor, um, yeah, agriculture, but man, that's really sneaking up on me like that. I just didn't. I was too focused on copper and lumber. Like that's my excuse. So this is the VIX thing he was talking about on the Game of Trades. Um, so to discuss what I'm seeing with the second leg, let's see, password. So the two things that made me suspicious, one is a forecast indicator, DBC, or no, DBA. We'll start with DBC, and we focus on this one. We zoom out because it's a forecast indicator. So this year, ooh, we're moving. So we actually had a huge spike up here. It's erasing what's the time we had in 2022. We had a huge spike. It's erasing it now. It's showing 2023, and we're heading towards. This is commodities. So we got one spike here, and then another spike in near August. So this made me suspicious of a possible second leg of overbought on this oscillator on the Williams cycle forecast. So that's what made me look at the long-term kind of outlook of commodities. Oh wow! Look at that. We're at the quarterly high, and we could fail it. We could go to. I don't know. I don't think we're gonna go all the way up there, but we're at the last quarter high. Good selling point to sell. So we want to look at DBC. Or DBA. So this is what made me suspicious of a second leg, is that we're holding really well the swing failure pattern here. And I like the moving average channel because it makes it pretty clear as to these swing failure patterns. So swing failure pattern is a deviation. So this is where the bears were wrong, and it's holding above the channel, which is, it's basically three moving averages. You got the moving average and the high and the low, and it's overcome a lot. It didn't close over anything other than this price here. The biggest thing to take note was the last year open in last year high and low close. So we broke out. If we took this back in time, which I don't know if we can. So this is when we broke out. We closed the quarter above, and this is what made me start to believe that we were heading towards a second leg. And we even closed a quarter above the last quarter, and it was just so strong. I think we ended up closing the 6 month above this moving average channel, which hasn't happened in a long time. So that's what made me suspicious right there. I think it was this candle was a 6 month close, and it was right there. So that's what made me really suspicious that commodities are seen as really cheap, especially like softs like agriculture. And the news in 2020 or 2021, 2022, where the start of the war, and then just agriculture just being decimated by either the drought or the farms being destroyed in Europe because they want to do away with the methane, or just like I don't know, like selling farms to make real estate. So those were some drivers to create a lot of lack of supply and to possibly push demand. So that's kind of what made me think of the thesis. And now we're closely watching the market structure, and it's heading that way. When we look at the soybeans, it's been holding. Coffee is reclaiming. Sugar is holding and it going higher. OJ is going nuts. Wheat reclaiming, getting ready to spike. Corn, lean hogs about to reclaim. Cattle, beef. During the drought, they ran out of ways to efficiently, cost effectively feed their cattle without having to go bankrupt, and they just decided to take them to auction early because they couldn't find anything that was cost effective enough to feed their cattle to prepare to have them breed again. And instead, they just took them to auction, and they didn't even breed them going into the end of the year. So that caused a huge supply crunch squeeze. Oats reclaiming, rough rice. So we either got a lot of reclaims or we got a lot of high prices holding on the softs, on the food. So that's not a good sign. And I don't think the Fed's going to be able to bring these things down. Like we had like 50-point basis hikes, 75-point. Now they're getting smaller. Like we might get a 25 or 50, but like it's never going to go back to like that aggressive increase again. They just have to hold it where it's at, and it's gonna the high price. The cure for high prices is high prices, so it's gonna make its run. And I just say prepare because that's pretty significant in my book. All right, getting back to finishing this because just uncovered something that I did not expect. So that's that one, and that's that one. Let's go to figuring out money. Okay, biggest competitor to the stock market is like the average return. So that's the host discusses rising treasury yields and Federal Reserve tightening cycle could draw investors away from stock market towards safer, more stable investments, which is causing the hedging into bonds, especially the forward part of the curve, like bills. However, he also notes that market is currently bullish, several sectors showing strong performance year to date. So he's conflicted. He's seeing like just contradictory information. Host also discusses recent macroeconomic data, including inflation, retail sales, and how the market has responded. And then he emphasizes the importance of paying attention to price action and volume because he's a technical guy. But boom, that's it. And then This is, I think this is the most recent one. No, this was like one that's far back. And then this is FX Evolution, more on stats. So he's saying that the discussion focuses on retail sales numbers, and while we came into higher than expected, leading to U.S. stocks ending higher despite the Federal Reserve's demand destruction policy. Video warns that there is a danger zone in the market, and that investors should be cautious considering interest rate hikes and inflation. And then the video urges investors not to ignore bonds, and they can trade risk and have disconnected from reality. So, like, I guess both markets have. So that's pretty much it. We went through a lot. I think the last one is the Vantage Point and possible bull trap in the dollar. So it's the AI for I don't know, environmental assessment of the finance industry is basically saying what I called out, which was the dollar coming back to this naked breaker and it being a bull trap. And there we go. We're starting to come down. We are starting to threaten the stability of holding this. I think this is the 24 moving average. So it's having a hard time holding it, and that's kind of what this Vantage Point AI is saying, and it's what I'm saying basically too. I endorse. Obviously, they're all best guesses. Best guess is like 51%. So instead of 50-50, it's like 51% confidence with just the homework. And that extra percentage point, it costs a lot. Like there's a lot that goes into it, and even with what I see, it's still a best guess because there's always things. Live data is ever changing, and you only got your best guess. So thanks for watching. See you in the next video.